Hello friends, and welcome to all of you to the yet another session on CA Final Direct Taxation. From today onwards, we will going to discuss about the assessment procedures, and in this regard our first discussion topic is the return of income. So what is the return of income? Return of income, it is a document which need to be filed by every taxpayer with the income tax authorities subject to section 139(1). So document hereby I mean that is the income tax form which have the specific information which is need to be filled by every taxpayers, and it is to be submitted with the income tax authorities but subject to section 139(1). Subject to section 139(1) just talk about the obligations to file the return of income. So now let's see what are the different taxpayers and under what circumstances they need to be submit the return of income, and what are the different due dates by which they need to be submit the return of income. So if the taxpayer is in company, whether it's a domestic company or a foreign company, then in all cases they need to submit the return of income by 31st of September of the relevant assessment years. Suppose a company is required to submit the return of income for the assessment year 1920, then the due date to submit the return of income is 30th September 2019. But if the taxpayer is in firm, then under all cases they need to submit their return of income. However, the due date to submit the return of income is different. If the firm is required to get their accounts audited, then under all cases they need to submit the return of income on or before 30th September of the relevant assessment year. However, if the firm is not required to get their accounts audited, then in all cases they need to submit the return of income on or before 31st of July of the relevant assessment year. So what are the different circumstances the firm is required to get their accounts audited? So this we will discuss in detail in our session on when we discuss about the BGBP. However, just to give an idea, if a firm consists of a proprietor and their turnover exceeds 1 crore, then they need to get their accounts audited. However, if the firm consists of a professional and their gross receipts exceeds 50 lakh of the relevant assessment year, then they need to get their accounts audited, and accordingly they need to submit their return of income. If the taxpayer is other than company or firm, like example is an individual and he is required to get their accounts audited, then in all cases they need to submit their return of income on or before 30th September of the relevant assessment year. However, if the taxpayer is not required to get their accounts audited and his total income exceeds basic assumption limit, then he is required to submit the return of income on or before 31st July of the relevant assessment year. The total income, I already discussed in our previous videos that the total income means the income which is after deduction under chapter 6A. However, as per the 6th proviso to section 139(1), it talks about if the taxpayer which is other than firm or company, its gross total income exceeds basic assumption limit, then he is required to submit the return of income on or before 31st July. So hereby I means that in case of individual, we need to remember that if their GTI exceeds basic assumption limit, then they need to submit the return of income as per 6th proviso. Now let's move forward and talk about the 4th and 5th proviso to section 139(1). It talks about if there is a resident other than not ordinary resident, means resident but ordinary resident, who is not required to file the return of income under section 139(1) as we discussed earlier, but he is having the beneficial owner, or beneficiary of an asset which is located outside India, then that resident is required to submit the return of income. Beneficiary owner means the owner of an asset, or beneficiary hereby I means who is not the owner of the asset, but he is getting the benefit from that asset which is located outside India, then that resident is required to submit the return of income. Now let's move forward and talk about the other provisions of section 139(1). Under section 139(4)(a), if there is a religious trust or charitable trust whose total income before getting the benefit of section 11 and 12, if their income exceeds the basic assumption limit, then they need to submit the return of income on or before the due dates, as we discussed earlier. If the taxpayer is the political party, then under section 139(4)(b), before exemption, if their total income exceeds basic assumption limit, the exemption hereby I mean the exemption under section 13(a). If their total income exceeds the basic assumption limit, then that political party required to submit their return of income on or before due dates. If the taxpayer is in hospital, medical school, colleges, investor protection fund, infrastructure debt fund, etc., under section 139(4)(c). Under section 139(4)(c), we have the other taxpayer as well, which you may refer to this section. If under this section, if their total income before exemption or before benefit under section 10 exceeds the basic assumption limit, then that particular taxpayer need to submit their return of income on or before due date. On or before due date we already discussed previously in this session. If the taxpayer is a university or college under section 35(1) subclause 2, then under section 139(4)(d), business trust under section 139(4)(e), and investment fund under section 115(ub), then under section 139(4)(f), if these persons are not required to file under any other provision of the Income Tax Act, then they are required to file the return of income under this section. As we just discussed about the taxpayers, the different taxpayers under different circumstances, they need to submit their return of income on or before the different due dates. Now, what else if the return of income is not filed or filed after the due dates? If there is a default under section 139(1), 139(4)(a), 4(b), 4(c), 4(e), and 4(f), which I just talked about a few minutes back, then if the taxpayers done the default under these sections, then they require to submit the fees, and that fees amount is 5,000 if the return of income is furnished up to 31st December of the relevant assessment year. However, if the return is filed after 31st December, then they need to submit the fees of 10,000 rupees. However, if the total income after deduction under chapter 6A does not exceed 5 lakh, then that fees amount, irrespective of the date of submit, either before 31st December or after 31st December, then they need to submit the fees of 1,000 rupees. Let me repeat again. If the taxpayer make a default under these section, and if total income of that taxpayer exceeds 5 lakh, then that taxpayer needs to pay fees of 5,000 if he submit the return of income on or before the 31st December. If after 31st December, then that person need to submit the fees of 10,000 rupees. But if that taxpayers having the total income which does not exceed 5,000, then irrespective of the period of submission of the return of income, they need to submit a fees of 1,000 rupees. If the taxpayer file the return of income under section 139(4)(a) or 139(4)(c), then if there is a default by these taxpayers, then there is a penalty of 100 rupees per day till this default continues. They need to pay the penalty to the tax authorities. Now let's move forward and talk about the other subsections of section 139. To this, the first subsection we need to discuss with respect to 139 is 139(3), which talks about the loss return. it says if the taxpayer having a loss under PGBP, that is profit and gains from the business or profession, or having a loss under capital gain, then they cannot carry forward their losses under these under these heads of the income if they file the return of income after due date. However, they can set off their losses. For example, if an assessee, say an individual who is having a loss under PGBP, and that taxpayer filed the return of income after the due date, then that loss they cannot carry forward to the subsequent assessment years. However, they can set off their losses with the other heads as per the provisions of the income tax. So, as per section 139(3), which talks about the loss return, if the assessee having a loss under PGBP and capital gain, then that taxpayer need to submit the return of income on or before due date in order to carry forward that particular loss under these sections. However, if they file the return of income after due date, then they can set off their losses with the different income under the different heads. However, if the assessee is having a loss under house property, then it can carry forward that loss even they file the return of income after due date. So, if the losses is under heads PGBP and capital gain, they can only set off but they cannot carry forward that loss. However, if the loss is under house property, then they can even carry forward that loss if they file the return of income after due date. If the assessee is having the losses which pertains to unabsorbed depreciation, then they allowed to be carry forward that loss due to unabsorbed depreciation even they file no return of income or they file the return of income after due date. This section also talks about the losses under section 35AD, which we will discuss when we will discuss about the PGBP, and losses under this section which talks about the income from the specified business. These specified business losses can be carried forward only if the assessee filed the return of income on or before due date. If they file the return of income after due date, then they are not allowed to carry forward the losses under this section. This section also talks about the remedies available to the assessee if they file their return of income after the due date. The remedy is that the assessee, in case of a genuine reason, if there is a genuine reason due to which they are not able to file the return of income on or before due date, then they can file the condonation request with the CIT if their losses is up to 10 lakh, with the chief CIT if their losses exceeds 10 lakh but up to 50 lakh, and with the CBDT if their losses exceed 50 lakh. And if these authorities finds that there is a reasonable cause for delay for not submitting the return of income on or before due date, then they can also allow the assessee to carry forward their losses. This condonation request cannot be applied after 6 years from the relevant assessment years. And there is one more point to consider here, that this application need to be disposed of by authorities within 6 months from the end of the application month. Suppose the application is filed in the month of January, then they need to dispose of on or before the end of the July of the relevant year. Now let's move forward and talk about section 139(4), which talks about the belated return. Belated return is a return which is filed after the due date but up to the end of the relevant assessment years or before the completion of the assessment year. If the return is not filed within the due dates, then that return can be called as belated return, and it can be filed up to the end of the relevant assessment year. Say, for example, if the return pertains to the assessment year 1920, then that return can be filed up to 31st March of 2020, and that return will be called as belated return. As I said in this example, for the assessment year 1920, the belated return can be filed up to March 2020 or before the completion of assessment, whichever is earlier. When you are filing the belated return, you need to make sure that you submit the fees as we discussed earlier in this session. Now let's move forward and talk about section 139.5 which talks about the revised return. First we need to see which return can be revised. The original return under section 139.1 plus the belated return under section 139.4 can be revised under section 139.5. And what is the time period within which we can revise the revised return? It is up to the end of the relevant assessment year or before the completion of assessment. Till then we can revise the return as many times as we can. And what is a revised return basically? If the assessee finds any error while submitting the original return or the belated return, and the time period within which the return can be revised, that is the end of the relevant assessment year or before the completion of assessment, has not passed, then he can revise his return of income under section 139.5. Now let's talk about section 139.9, which talks about the defective return. So what is the defective return basically here? I mean, defective return is a return which is not submitted in the prescribed form, in which proof of tax claim, that is TDS, is not attached, and tax audit report under section 44AB is not attached. Normally these are not required in today's world. However, if these proofs are not attached, then that return shall be called as defective return. The point here is note that if the tax under section 140A, which talks about the self-assessment tax, has not been paid on or before the due date, then that return shall not be called as defective return. Still, that return called as a valid return. If the AO is find any defect in the return due to these reasons, then AO may send intimation to the assessee to correct that defects, and that defects need to be corrected within 15 days from the intimation. However, in case of a genuine reason, the AO at his discretion may extend the time period from the 15 days. And if the defects which is intimated by AO is not corrected within the timelines mentioned in that intimation, then that return shall be called as that no return has been filed by that taxpayer. So the taxpayers need to correct those defects within the time frame mentioned in that intimation. Now let's move forward and talk about the section 139AA, which talks about the quotation of Aadhar. As you might aware that the Aadhar quotation is mandatory while submit the return of income. However, it is also this section also mandate the assessee to link their Aadhars with the PAN number, and if the PAN number is not linked with the Aadhar, then that PAN number will be considered as invalid. However, the Supreme Court stay this order, and the time frame is not yet decided, and the time is not mentioned, but still the time is not being given by the Supreme Court. We have to consider that the linking of Aadhar with the PAN number is not mandatory. However, we need to quote the Aadhar while submitting a return of income. If the person is not having the Aadhar number, then he may also mention their enrollment ID in place of the Aadhar number while submitting the return of income. So this section is applicable from 1st July 2017, and this provision is not applicable to the following persons. So if the person is residing in the state of Assam, Jammu Kashmir and Meghalaya, then that particular taxpayer is not mandatory to quote Aadhar while submitting their return of income. If the person is a non-resident as per Income Tax Act, if he is having an age of 80 years or more, or who is not a citizen of India, then these persons are not required to quote Aadhar while submitting their return of income. In this way, we have completed our first session on assessment, that is the return of income. In case you have any query or any feedback, then please write to us on this email ID, which is tarun2988@gmail.com, and you are requested to please share your feedback or any question or any query you have. If you like the video, please hit the like button, and also you are requested to subscribe to our channel for the further videos. For this, I just like to close this chapter and wish you all the best for your examination. Thank you.